Hey everyone, and welcome back to The Explainer. Today, we're putting on our expert investment analyst hats to conduct a top-to-bottom due diligence report on Waters Corporation. We're going to take their latest data and run it straight through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some strict DCF modeling just to see if this $37 billion giant is actually a buy. We've got a ton of really compelling data to sift through today, from deep dive technical specs all the way to some pretty highly nuanced Q1 financial filings. So let's get into it.
Okay, here's our game plan for today. We'll kick things off with the company snapshot, move into the Q1 financial pulse, check in on Wall Street sentiment, and wrap it all up with our final verdict.
All right, let's jump right into section 1, the company snapshot, and see what's going on inside their economic moat. So if we're looking at this through a classic Warren Buffett lens, we are hunting for an undeniable economic moat, right? Well, this hardware is exactly that. What you're looking at is the Discovery TGA 5500, a top-tier thermogravimetric analyzer from Waters TA Instruments division. Now, let's be clear, this is not just standard lab equipment. It's a high-performance system literally designed for researchers who absolutely require the highest sensitivity and the most accurate data possible. It's built with this patented IR furnace, and it delivers the fastest heating and cooling rates in the industry, all while keeping signal drift to the absolute lowest levels. And, when you're building the gold standard of testing equipment, you are effectively building a massive barrier to entry for any competitors. But you might be wondering, how does this fancy hardware actually translate into those consistent, predictable earnings that us value investors demand? Well, these high-pressure TGA machines aren't just sitting in a lab looking pretty. They solve incredibly complex, heavy-duty industrial problems. They're uniquely suited for analyzing stuff like high-temperature corrosion, coal gasification, and catalyst materials. By embedding their tech right into the critical workflows of these massive industrial processes, Waters manages to create a deeply, deeply sticky customer base. And that's exactly what ensures the reliable owner earnings that form the real foundation of a true moat.
Moving on to Section 2, the Q1 financial pulse, or what we're calling the earnings paradox.
So the huge catalyst for our financial discussion today is this massive top-line figure, $1.27 billion in Q1 revenue. Just to put that into perspective, that is a colossal jump compared to the $662 million they reported in the exact same quarter just 1 year ago. Actually, if we apply the Peter Lynch lens here for a second, this kind of explosive leap briefly morphs Waters from a nice, steady stalwart right into that exciting fast grower category. But the absolutely crucial point here is understanding exactly where that revenue explosion came from. The headline number shows a staggering 91% overall year-over-year revenue growth. But as analysts, we have to look a little deeper. This huge surge was primarily driven by their recent BDS acquisition, which dumped about $520 million into the quarter. However, the thing that should really give investors confidence is that even without that massive acquisition, the core legacy Waters business still posted a very healthy 13% increase in revenue. And honestly, that 13% is the true health metric of this company. Plus, legacy revenue was up 11% in Asia, heavily led by China, and saw an incredibly impressive 26% jump in Europe. All right, so here is where we hit that paradox I mentioned. Waters delivered a really strong beat on revenue, coming in over 5% above estimates, and they totally crushed their non-GAAP earnings per share, hitting $2.70 against an estimated $2.31. That is a nearly 17% surprise. Yet, if you look at the bottom line on a strict GAAP basis, they actually reported a net loss of $72 million. Now, a Benjamin Graham defensive investor might see this lack of earnings stability and immediately flag it. But why did it happen? Well, the answer lies in the friction of growth. This loss heavily reflects short-term amortization and step-up costs. Basically, we're looking at the upfront accounting penalties and paper losses they had to take when integrating that massive BDS acquisition. Okay, Section 3, Wall Street sentiment. Let's try forecasting the future a bit. It's pretty clear that Wall Street genuinely believes the short-term integration pain is going to be totally worth it in the long run. Analysts are currently projecting a Q2 EPS of $3.01, which rolls up into a very optimistic fiscal year 2026 projection of $14.51. That's a solid 10.5% bump over the prior year. But then, look ahead to 2027. Analysts are projecting another massive 14% year-over-year jump to $16.54 per share. In Peter Lynch's world, if your PE ratio is justified by this kind of aggressive double-digit EPS growth trajectory, the stock suddenly becomes incredibly attractive. Basically, Wall Street is looking at this acquisition as a giant slingshot for their future earnings power. And that optimism is really reflected in the price targets, which are, of course, heavily driven by Wall Street's discounted cash flow, or DCF models. Rapid firing through the data from 31 different analysts here, we see a pretty wide spread. We've got a low target of $285 from Wells Fargo, stretching all the way up to a really bullish $480 from Wolfe Research. The overall consensus sits right at $399. But when analysts run their DCF sensitivity tables, tweaking that weighted average cost of capital and terminal growth rates, heavy hitters like Goldman Sachs still arrive at a $425 price target. That suggests a really solid 12% upside from current trading levels.
Finally, Section 4, the final verdict. Let's synthesize all this and give our recommendation.
All right, so to synthesize all of our frameworks today, under the Buffett lens, Waters absolutely possesses a brilliant economic moat. They've got explosive recurring revenue coming from the BDS integration, with consumables and services up a staggering 123% year over year. On top of that, their legacy business in Asia and Europe remains incredibly strong. However, looking from a grand perspective, that near-term gap loss and the recent stock underperformance, returning just 6.7% over the past 52 weeks against the broader market's 20.6%, means you absolutely must carefully calculate your intrinsic value. You have to ensure you have a proper margin of safety before buying in.
So, based on this complete due diligence report, the final question you've really got to ask yourself is this: does Waters have the right chemistry for your portfolio? Do their long-term technological dominance, that highly sticky industrial customer base, and those fantastic double-digit EPS growth projections outweigh the short-term balance sheet friction and recent market underperformance? Honestly, that is the multi-billion-dollar question. Thank you so much for joining me for this explainer, and as always, keep doing your own rigorous analysis out there.